Many aspiring investors find themselves paralyzed by a common, yet profoundly misleading, belief, the not rich enough myth. This pervasive fear suggests that you need a substantial fortune already accumulated before you can even begin to participate in the world of investments. It conjures images of Wall Street titans and intricate financial maneuvers, creating a psychological barrier that prevents countless individuals from taking their crucial first steps towards financial independence. This myth is a significant hurdle because it fosters a sense of inadequacy and exclusion, making wealth building seem like an exclusive club rather than an accessible journey. It's a misconception that often leads to procrastination, costing individuals valuable time, which is arguably an investor's most precious asset. Today, we're going to dismantle this myth, revealing that true wealth creation is not about where you start, but about when and how consistently you begin. The truth is, the not rich enough myth couldn't be further from reality. The investment landscape of today is remarkably accessible, designed to accommodate individuals from all financial backgrounds. You absolutely do not need to be a millionaire to begin building wealth. In fact, some of the most successful investors started with very modest amounts, leveraging consistency and time rather than a colossal initial sum. The power lies not in the size of your initial deposit, but in the discipline of regular contributions, even if they are small. Modern investment platforms and vehicles have democratized access to markets, making it easier than ever for average individuals to participate. This shift has fundamentally changed the game, emphasizing that consistent, strategic investment is far more impactful than waiting for a large windfall that may never materialize. Your financial journey begins with a single step, regardless of how small it seems.
Let's put this into tangible terms. Imagine investing just $50 to $100 monthly. While these amounts might seem insignificant on their own, over time, they possess extraordinary wealth-building potential. This isn't about making a one-time splash. It's about forming a sustainable habit. By consistently setting aside even a modest sum, you are actively participating in the market's growth rather than sitting on the sidelines. For instance, putting $50 into a diversified S&P 500 index fund consistently for 30 years could accumulate to a significant sum, potentially hundreds of thousands of dollars, far exceeding the initial contributions. This consistent approach removes the pressure of needing a large lump sum and makes investing a routine, manageable part of your financial life. It proves that sustained effort, not sheer capital, is the true engine of long-term financial success. At the heart of transforming small contributions into substantial wealth lies the incredible force of compound interest. Often called the eighth wonder of the world, compound interest is essentially earning returns on your initial investment plus the accumulated interest from previous periods. Imagine a snowball rolling down a hill. It gathers more snow, growing larger and faster as it progresses. Your investments work similarly. Each time your investments earn interest or dividends, that money is reinvested, and then that reinvested money starts earning its own returns. This exponential growth dramatically accelerates your wealth accumulation over decades. The longer your money is invested, the more powerful compound interest becomes, turning modest, consistent inputs into a significant financial legacy. It's not magic, it's mathematics, and it's a game changer for anyone starting early, regardless of the initial amount.
One of the biggest fears for new investors is market volatility, the idea that the market might crash just after they invest. This is where dollar-cost averaging becomes an invaluable strategy. Dollar-cost averaging means investing a fixed amount of money at regular intervals, regardless of whether the market is up or down. For example, consistently investing $100 every month. When prices are high, your fixed sum buys fewer shares. When prices are low, the same fixed sum buys more shares. Over time, this strategy averages out your purchase price per share, effectively reducing the risk of making a large investment at an unfavorable peak. It automates your investment decisions, removing emotion from the process and turning market downturns into opportunities to acquire more assets at a lower cost. This method is especially beneficial for beginners, offering a disciplined and less stressful way to enter the market. Starting your investment journey doesn't require complex derivatives or hedge funds. There are several highly accessible and effective investment vehicles perfectly suited for beginners. Consider Roth IRAs and 401ks for retirement savings. These accounts offer significant tax advantages and are often employer-sponsored, making contributions straightforward. For broader market exposure, S&P 500 index funds or exchange-traded funds (ETFs) are excellent choices. These low-cost, diversified options allow you to invest in a basket of hundreds of companies, mirroring the performance of a broad market index like the S&P 500, thereby reducing individual stock risk. They require minimal management and are ideal for long-term growth. Moreover, these options help beat inflation, ensuring your money grows faster than its purchasing power erodes. These vehicles provide a robust foundation for building wealth without needing to pick individual stocks. Beyond the not rich enough myth, other psychological hurdles frequently deter new investors. The fear of market volatility is paramount. Seeing headlines about market downturns can be unsettling, leading to panic selling or a complete avoidance of investing. However, historical data shows that markets recover and grow over the long term. Another significant obstacle is analysis paralysis, where the sheer volume of information and investment options leads to indecision and inaction. Instead of starting, individuals get caught in an endless loop of researching, never making a move. It's crucial to understand that perfect timing or perfect knowledge isn't necessary. The greatest risk often lies in not starting at all. By acknowledging these common fears, we can strategically work to overcome them, understanding that calculated action, even small, consistent action, is more valuable than perfect inaction. So, how do you actually begin? Your first practical step is to prioritize building your financial literacy. Understand the basics of budgeting, saving, and the investment options we've discussed. Utilize accessible platforms like reputable online brokerages or robo-advisors that make investing simple and often have low minimums to start. These platforms provide user-friendly interfaces and often offer educational resources to guide you. Start by setting up an automatic transfer of $50 to $100 monthly into an S&P 500 index fund or an ETF within a Roth IRA or 401k if available. The goal isn't to become an overnight expert, but to establish the habit and let time and compound interest work their magic. Remember, the most powerful decision you can make is simply to start. Don't wait for the perfect moment or a large sum. Start with what you have today. We've journeyed through the core principles that shatter the not rich enough myth and empower you to take control of your financial future. Remember, investment is not an exclusive club. It is a powerful tool available to everyone willing to take consistent, disciplined action. Your journey starts with embracing the power of small contributions, like $50 to $100 monthly, harnessing the exponential growth of compound interest, and mitigating risks through strategies like dollar-cost averaging. Don't let fear of market volatility or analysis paralysis hold you back. Begin by building your financial literacy and leveraging accessible investment vehicles such as Roth IRAs, 401ks, S&P 500 index funds, and ETFs. The most crucial takeaway is this: the sooner you start, even with modest amounts, the more time your money has to grow. Your future wealthy self will thank you for making the decision to invest not someday, but today.